I see some of you. I think there's like 24 of you that I can actually see, but still good to see many of you. Thanks for joining us today. And thanks for humoring me on another virtual event. I know there's a large majority of you that are kind of fatigued of virtual events, but at the same time, I think we learned something from the pandemic. We learned two things, right? We really like to be in person. We're really efficient working when we're not in groups, but yet we also miss the collaboration. So I think in some ways, the pandemic has taught us how we can use a platform to connect with each other and to maybe connect across university lines or across political parties, which is not true. I mean, parties as in academics and practitioners. But I want to just start out with just some of like the basics behind the group, just so you can kind of understand what we're trying to do. Really, the goal of this group is really just to make us all better at what we do. So if you're an academic or if you're a practitioner, if we could just do more together and do more at learning on how to be better at our jobs, I think that's our goal. And then I think there's going to be a lot of adjustments throughout time to make this platform and this group work to get us the most benefit. So over time, if you have suggestions on topics or speakers or structure, I'm all ears. I realize that 170 people on a Zoom call is not going to be as interactive as we like. So hang in there. We'll have some meetings that are smaller, and we'll hopefully have an in-person meeting. But in general, I just want to say welcome. I'm really glad to have you all here today and have a great conversation about ESG assurance, hopefully. With that said, I'm going to turn it over to Jeff Hales, our resident expert on ESG. He's going to lead us through a Q&A with our guest speakers on ESG reporting and assurance, and then we'll open it up to a broad audience Q&A. That said, I will encourage you, if you have questions, I know our speakers well enough to say that feel free to raise your hand. They definitely are open to answering questions probably at any time. All right, with that said, I'm going to quit talking and blabbing on and pass it over to Jeff. Thanks, Jeff.
Thanks, Jamie. So thanks for hosting this. I think it's a very interesting and timely topic, and we've got some great panelists here to chat with us. Should we just give them each a second to kind of just introduce themselves? Maybe we'll start with Brandon.
Thanks, Jeff. Yeah, I'm Brendan Gipper, so I'm an associate professor of accounting at Stanford University. I think Jamie invited me because she discussed and gave very helpful advice on a paper that I'm working on. And I think mainly I'm just going to try and give you some descriptive statistics for that, but I'm learning about this topic more and more all the time, and it's very interesting.
Definitely a lot of interesting stuff around climate going on at Stanford, I would say. So great that you can be here. And then Jim.
Thanks, Jeff. I'm Jim Burton. I am the partner in charge of the ESG and sustainability practice at Grant Thornton. I have been with Grant Thornton for a number of years, 33 in total, in a variety of roles coming up through the audit practice. I was the chief auditor for the firm for 8 years, and have been leading the ESG practice for about 2. I chair the AICPA's Assurance Services Executive Committee, and I'm very familiar with the ongoings in the non-financial attest world, including ESG. Had some interactions with Jamie and some others in the research world, and believe that the partnership between academic and practice can lead to a lot of good insights that help us make things better, both from a client perspective, from a quality perspective, and a usefulness of the information that's out there, and always willing to step in front of a group of professors and have a dialogue about where things are going and what we're seeing, that we can spur on each other's thoughts process. So thanks for the invitation.
Thanks for the willingness to engage. I don't know if you're brave or easily duped, but we're glad that you're here. So thank you, Jim. And then I think many of you know me from UT Austin, but also I think the reason Jamie asked me to be part of this is I've been thinking about sustainability issues for the last decade. Much of that through my work with the Sustainability Accounting Standards Board. The SASB standards still exist, but the SASB organization has been incorporated into the ISSB, the International Sustainability Standards Board, which I now sit on. And so, I am not an audit expert by any means, but I have been thinking a lot about the assurability of these disclosures. And so I'm really happy to be part of this conversation. So with that, maybe we'll go ahead and kick it off. And we have some questions just to sort of lay the foundation of this, and really kind of wanted to start off with a question for Jim to help us think about, what is the role that the accounting firms, the CPA firms, are actually playing in the space of ESG reporting. How have they been thinking about this and part of it?
So when Grant Thornton, like most of the top 500 accounting firms out there, provides audit, tax, and advisory services. And when we were doing business planning a couple of years ago, and looking at the kind of the next 2, 3, 5 years, ESG as a topic kept coming up over and over and over again as things that our clients were asking about. And when we looked at the skill sets and what they were asking about, we realized that we were actually fulfilling and providing a number of these services currently, but doing it in a very ad hoc way. So, in the advisory side, we might be helping an entity think about system implementation or about strategy or kind of under the ERM framework, the risks and opportunities that were out there associated with climate-related matters or other ESG topics, but we really didn't have a cohesive approach to the delivery of that service. So we put the services together so that we could think about them a little bit more holistically and really try to answer a client's question as it went on its sustainability journey and its individual growth, whether it be creating some initial disclosures, whether those were internal KPIs or external reporting elements, all the way up through how do the topics align with the company's stated strategy. And when we think about what our clients are asking us to do, it really isn't new, right? ESG is not a new thing, right? It is very common business challenges, problems, and opportunities that entities have faced forever, right? If you take things like DE&I, having an engaged workforce, retaining that workforce, and having them produce has always been important to enterprise and organizational success. Changing customer demands, changing supply sources, regulatory environments, how we manage those are all things that entities have done. But the focus on some of these topics and the recognition that some of these topics have maybe larger impacts in the medium and longer terms and how those affect enterprise value has become more prominent. And while we can say they're common business problems, there are two dynamics of this that are very different than what's occurred over the last 30 years. One is the attention, involvement, desire of stakeholders and a broader stakeholder group to be involved in understanding how entities are managing these aspects of the business and asking for data and information around those topics, and which is spurred on the reporting element. And if you look at all of the numbers and some of the research that Brandon's paper covers, the amount of growth that's occurred in ESG reporting and the information that's being reported there, the fact that each year there's far more data and information being covered. That is really what the change is. And then you look at what accounting firms' strengths are around reporting and compliance, the validity and verifying information, creating processes that can continually produce reliable information at scale and in compliance with sets of frameworks, standards, or guidance. That's really where the accounting firms are helping a lot and where we are growing our practices. So when I think about what the accounting firm's role in ESG and ESG reporting is, it's very similar to what we've done in a lot of other areas, with a new subject matter being the focus of that. So for example, emissions information, and our accountants, they've learned how to account for pension obligations and revenue recognition. Now they're learning how to account for and understand sources for emissions data.
That's super helpful, Jim. I really appreciate a number of the things that you said in there, and maybe just touching on what you just said and how much it resonates. I mean, if you think about what tasks we give the accounting profession, it's, at least as complex as business itself, because anything that happens as a business activity ultimately could have reporting implications and potentially assurance implications. And so I sort of think back to the fact that companies were offering stock options before Black-Scholes existed. Actually, they were offering to pay the retirement benefits of companies before we really thought about how to model any of that. And so companies can offer all sorts of business, they can engage in all sorts of business activities. And at some point, if we're trying to facilitate accountability around that, we have to sort of stop and say, what is that thing, and how are we actually going to do that? And so your idea that that this is not new also really resonates. I think it often feels as if it is. And that's probably for a number of reasons. But I think what's new are some of the transparency, some of the expectations that are being required by, as you mentioned, the broader stakeholders, by governments, by customers, but also, ultimately, I think that feeds back into investors also needing to know more about this as well. So really, really great way to tee that up. And in case you wanted, feel free to echo anything back if you want to comment on that. But I also wanted to jump over to Brandon for a second. So Brandon, I want to ask you about, what is the current state of assurance, but given that you've been thinking about this, and maybe, we have a lot of researchers listening, and, I think everybody loves some practical knowledge, but at the end of the day, people want to know, what's a good research topic, what's current state. So can you talk a little bit about first, just what are you thinking about as a researcher in this area?
Yeah, thanks for the question. So, the thing that I'm working on recently is just looking at descriptive statistics, because I think that, we have a really good handle of descriptive statistics for a lot of financial information and auditing in the financial space, but we're still bringing together kind of these very diverse data sources into looking at and understanding the descriptive statistics in other non-financial outputs of companies. And so I think, especially in the US, where this is much more emerging than it is internationally, there's a dearth in our understanding of just what's happening. And so this is what I was hinting at earlier when you first kind of give me a chance to introduce myself. So I think I'm going to share a couple of slides actually and just show you some of these descriptive statistics. Give me 1 second.
Actually, while you're pulling that up, can I just give a sort of a hallelujah to that, actually, because I feel like we all study the cycle of research, that we're informed by things we observe, and that feeds into making, forming theories about how the world works, which we go out and empirically test, and it's like a feedback loop. And we've been doing that in a number of areas for so long that we started to really ask very technical questions around identification and causality, how much do, almost epistemological, how do we know really, and yet in this new area, there's so much that we just don't know yet. And I feel like all across the ESG space, we're in dire need, actually. I think there's some really good stuff on this. So I'm super interested. So go ahead.
Yeah, thanks. So I think that actually I should preface, so my title here, and this is the study that I was hinting at, is ESG assurance in the United States. There's actually a huge amount of research that I'm sure people on this call have participated in, looking globally at this topic and kind of giving descriptive statistics and giving kind of research questions that around the world, because I think that the United States is a little bit behind, especially EU countries, in doing these sorts of things. And so we decided, me and my co-authors decided to look at the US in particular and try and gather some data. So I'm just going to actually jump right in and tell you what data we have, and then show you some figures to give a sense of where we're at with respect to ESG assurance in the US. So the data that we're looking at are S&P 500 firms over the last decade. And so we keep any firm that had been in the S&P 500 no matter what. So we ended up having 750 firms in total. We got the ESG reports from this data provider corporate register, and then we supplemented it with CDP, or the Carbon Disclosure Project and Refinitiv data. And then we're going to use that corporate register data to look at just things like assurance status, assurer identity, and then whether companies are using various ESG reporting, and I'm going to use this terminology, frameworks. So I think for each of these, like GRI, SASB, TCFD, they might use different words to describe what they're providing companies. And then I think what makes our data pretty interesting is we actually looked into the specific assurance statements that the assurers provide to look at what specific things are being assured. And the reason that I think that this is really important is with financial statement audits, we know, oh, they look at everything in the financial statements and make sure it's compliant with GAAP and that they're using gas in order to do that work. But because there's no requirements around ESG assurance, there can be a lot more diversity in the type of things that get assured and then how they're assured. Plus also the mix of assurers varies quite a bit as well. So not just traditional auditors, but also these more kind of non-financial assurers that tend to focus in this area. So I currently have a team of Amazon MTurkers that are collecting 6 different measures of environmental performance. So we do the 3 different scopes of greenhouse gas, and then also total waste, total energy, or total water use, and then 5 different measures of social performance. So employee gender and racial mix, employee safety, and then gender and racial pay balances. And what we're collecting is basically the assurance status of each measure. So I'm going to start at a high level with some of the data and then just go down to a low level with this manually collected data. So here's what's happening over the last decade amongst S&P 500 firms in the US. So the difference on the left there in panel A between the red line and the blue line is just how much reports are coming out that contain some assurance. And so you can see that there is a spread happening. So there is increasing rates of assurance amongst ESG reports. And that's what's in the right panel, the panel B, which is just giving these in percentage terms. So actually the US in 2020, and this is for fiscal 2020, not what's reported in 2020, are actually closer in rates to some non-US countries in that if you divide 19.6 divided by 76.2, you get like 26% are actually having some assurance. And these, I should also point out, are in the public facing ESG reports. And there's more assurance that's happening behind the scenes. So like if you look at CDP data, for example, you see higher rates of assurance. But this is when companies report to CDP, hey, we are getting assurance on our greenhouse gas emissions, but not necessarily putting that same assurance statement into their ESG reports that they release publicly. So the other thing that we spend a lot of time thinking about in this project is also just these increased adoption of reporting frameworks. And so over the last decade, it's also kind of up and to the right with all of them. And so there's kind of higher base rates in GRI use or reporting to CDP, but of course there's big emergence in use of the SASB standards or the TCFD principles. And so we see kind of big upticks in all of those things, but especially with those latter two in just the last few years. So again, at a high level, let's talk a little bit about what's happening in the US with respect to assurer mix. So the blue at the bottom are kind of big 4 traditional auditors, and then across the other grays are these more non-financial assurers. And so you can see that basically over the last decade, what's happening is there's still a fair bit of fragmentation relative to auditing markets, but there's also increased concentration amongst the non-financial assurers. So kind of these big ones, ERM, Lloyd's, and Apex, have really grown their market share, but not at the expense of traditional auditors, instead at the expense of much smaller non-financial assurance providers. So the big dark box at the top there is getting smaller and smaller. The other thing that I'll point out is you can see that what was Bureau Veritas is actually kind of shrinking down a little bit with Apex replacing it. That's because Apex has actually acquired a portion of Bureau Veritas's assurance practice. All right, so now I'm going to dig a little bit more into the manually collected data that we're gathering still. And so the red line is the number of those 11 metrics that companies report in their ESG reports. And then the blue line is how many of those metrics get assured. And so across time, again, things kind of up and to the right, where of 11 metrics, it seems like there's 7.3 reported across those. So, more scope for reporting, but then also more scope for assurance. So the vast majority of this is coming from environmental metrics with respect to the assurance increasing through time. So if we split on E versus S, it's kind of increasing in reporting for both E and S, but mostly increasing in assurance amongst the E metrics. Okay, S metrics are assured at kind of some low rates, but we see increased reporting in both. And so if you look at in a comprehensive view, as kind of assurance penetration within the ESG reports are increasing about through halfway the decade, and then they start to level off a little bit. And that's just because of increasing reporting of S metrics through the last 5 years. All right, so just one more image, with 2 panels anyway, and then I'll hand it back. So I just wanted to also talk a little bit about the scope of assurance. So there's, of course, a big set of ESG reports that have no assurance, and that's kind of what this big bar is in panel A. But then if you think about how much gets assured, that average number that I was showing you in those prior figures is actually pretty evenly spread across reported metrics. And so even once we throw out that big bar of nothing gets assured, you still see a pretty even spread and even a little bit of mass on everything gets assured amongst reported numeric metrics. And then if I split this by E and S and also by financial auditors and non-financial assurers, one of the things that we see is that there's kind of more focus on environmental metric assurance amongst the non-financial assurers and slightly more focus on social metric assurance amongst traditional financial auditors. But otherwise, there's not too much difference between the two. But in the paper, we look a little bit more at like different frameworks that seem to be focus of different types of auditors, et cetera. All right, so anyway, that's some high-level descriptive statistics of what I've been working on.
Great, thanks, Brandon. That's super interesting, and we could spend a little bit of time maybe just thinking about some of those patterns that we just saw. So, when you think about, it looks like more assurance around the E issues than the S, and there could be like a number of reasons for that. And so, one of the things that we could think about to try to answer that is to ask the question, why are companies getting assurance, actually? So do you have any thoughts on insights into why companies would get assurance?
Yeah, so I think kind of a thing that people think about with this is like where's the demand coming from? So is demand coming from investors themselves, or is demand coming from like other external stakeholders, like maybe regulators or employees themselves? And so one of the things that we thought about looking at specifically was like what happens with investors when these assurance practices are used. And we actually didn't find, but again, this is over I want to emphasize, over the 2010 through 2020 decade, that we didn't see as much sort of kind of voice or exit type measures associated with ESG assurance and this ESG reporting. But we did see some amount of, with the reporting, some sort of kind of voice and exit type activities, including more engagement with boards. And so I think, if you're thinking that investors maybe aren't supportive of assurance, I think what investors are definitely supportive of is standardized reporting. And so I think that basically to the extent that assurance supports that standardized reporting, then it has this kind of supplemental benefit that investors are demanding. I think also we'll probably talk about more kind of what sort of role regulators are playing. And I think companies are definitely thinking about that as well when moving towards having more assurance, because potential mandates here in the US and forthcoming mandates in the EU is definitely leading into that as well.
Yeah, so that's super helpful, and I'll maybe ask Jim to like weigh in if he's got any thoughts on this too. But I just want to kind of share a couple thoughts and maybe just like preface this by saying, I've been an academic for like dog's years, let's just say like that, so and I remember in the early days, there were lots of questions around what's the value of an audit, right? Lots of questions around like, why do we even have auditing? What's the value of that? That's back in the efficient markets days. Like, if you're not even sure why we have accounting information, you're definitely going to ask questions about like, why do we assure it? But, in a mandated world, you have to really kind of like back into the value of an audit. But in a world where assurance isn't mandated, then it's a choice. And like, there's all sorts of endogeneity challenges around that, but it's a real opportunity to exploit some variation in practice to try to get a sense on like the value of assurance and the drivers of it. And so just adding onto what you said, Brandon, I want to mention a couple of things. I mean, I think on the one hand, almost from the company's perspective, I think there's reasons that companies want to get assurance. And sometimes I think it's been because they want to get some of the benefits that come with assurance. And we usually think about that as being like, more reliable information. But in a world where there are raters and rankers who are just sort of like ticking a box and saying like, hey, there's bonus points if you get this, then I think that's one potential incentive that we often don't actually think about. It's not independent from value, quality of information in a sense. Maybe that's why these raters or rankers are incentivizing it, but it's sort of like an explicit check the box there. And then I think also companies feel a degree of comfort when they've brought in some outside person to say, hey, we can stand behind this. And they're, the way that they might value that could depend on who they're talking to, who they believe they're talking to. And as you sort of showed, like the spike in what I think of as like the investor-oriented disclosure frameworks in the last few years, that could also really sort of change the company's perspective in terms of like what sort of comfort they want before they put some information out there. And Jim, I don't know if you've got any thoughts on that.
Yeah, I mean, you guys have hit on several things that we talk about quite frequently with clients about who are entering into or trying to understand what the progression of their reporting and potential assurance requirements or expectations may be. We break down both the reporting and the assurance as being driven usually by one of three motivators. It's either a market-driven motivation, and that's where we include investors, right? So somebody is saying that there's more value that we place in you because you are either reporting this information or you're getting it assured. And therefore, from a market perspective, we're approaching it. Falling into that category is also our brand reputation, because there's a lot of entities. Every industry has got market leaders and market followers. And many of the market leaders are stepping ahead of their peers by saying, not only are we reporting information, we're reporting more information, we're providing additional input and information and kind of data around that, and getting it assured because that's our brand. That's what we want to do. So in that market bucket, there are definitely drivers. Honestly, I don't think most employees understand the difference between any of the assurance reports that are out there. But when they read that there's assurance, there's a little thing that ticks in their head that says, hey, that this company is saying that somebody else other than them verified this, and creating that little bit of value. So each of the stakeholder groups that have driven the increase in reporting gets a different perspective, and potentially the entity reaps a benefit from having all those stakeholder groups seeing that it was assured. Then there's the contractual requirements, whether it be in a lending arrangement or an investment arrangement, or even in a supply chain arrangement, that you will not only produce this information, but get it assured, right? So there's some people who are doing it contractually. And then the last piece is the regulatory piece, right? Where a regulator is requiring it. When we draw a distinction between the contractual and the regulatory, because you didn't have to enter into that contract. You could have done something else. You don't have to be public either, but you can, when you do that, you're choosing to accept those elements. And when we look at those three buckets and we look at why people are getting the assurance, some of it currently is because they feel like they don't have a choice, right? You brought up the raters and the rankers. CDP scores you better if you have assurance over the information that you're reporting. And people are trying to say, how do I improve my scores? Because even though they don't know how to convert that score to their own current profit and loss, or maybe even their enterprise value, they inherently know that somebody is making a comparison of my grade against someone else's grade, and therefore I need to do that. But I think the other side of it is that people are getting more comfortable with the information, right? They're getting, when you think about the progression of disclosures, right? It's a lot of policies and principles to start. Then you get into some data. Then you start focusing on the frameworks, and then the tone of the disclosures change a little bit. It becomes a little bit more factual than promotional. And that provides an opportunity for the information to be assured under some criteria. And all of those are contributing as people are getting more comfortable, it's getting more common. And as your peers take it on, you start falling behind your peers. And it's like, hey, 43% of our competitors are getting this information assured. We should probably get it assured. And so I think that's what we're seeing driving it. Is there's a lot of momentum that will do it. If a US regulation comes into place from the SEC, we will see it step up significantly just out of a compliance perspective. But I had an interesting conversation with the CFO several months ago who, we were talking about getting their information assured and reporting it and what they were going to be required to report. And his comment was, I am convinced that at the next election, this will go away and it will get toned down and we won't have to do this. And I said, but you're already publishing this information voluntarily in a sustainability report. Help me understand why you're doing that. And so, the regulatory side of it and the scoring side of it is a component, but I think it's masking that companies are believing that their stakeholders, whether it's a direct valuation change or just empirically knowing that it matters to their stakeholders and there will be a benefit, is improving the momentum.
Thanks, Jim. Yeah, I just think there's so much in what you and Brandon had said about like that sort of lends itself to empirically researchable questions, and you can think about these sort of things like, I'll just mention one other thing that I don't think you guys exactly hit on, but like think about like whether a company is using ESG in some way in executive compensation. Like if they're doing that, then they might want to get outside assurance out. They're almost certainly going to want some controls on those measures if they're going to be paying out compensation as a function of it. And there's just like a really evolving practice here. And your point, Jim, about like peer comparisons is a really good one. I was having conversations with some chief accountants of not chief accountants, but sorry, the chief accounting officers at some very large businesses. And one of them was saying like they had just hired their first controller of sustainability, right? Like they're going to have two controllers, one over financial and one over sustainability disclosures. And, that's not exactly getting external assurance, but nobody wants to get assurance and find out they're doing a terrible job in some sense, right? So it almost like gets them, in a position where they'd be more willing to have somebody come in and check because they actually feel better about the quality of things that are happening. So some of this is, there's so many factors that I think, from a research perspective, it would just be really great to study some of these things. So
you bring up that employee compensation one, and that is a factor as more KPIs and metrics and achievement of metrics are influencing employee compensation. Companies audit committees are asking about what are the controls around it, who's validating the information. And with all of the continuing growth and requirements around compensation disclosures, there could be a research opportunity there to connect the disclosed information along with what's being disclosed about how the compensation program works and how does it relate to performance, right? I'm not a researcher, but there definitely seems to me to be a connection there, because sometimes you get it assured because I now have it, right? And if you're going to put these metrics in from a comp perspective, you're obviously gathering some information to be able to determine accomplishment of those objectives.
So let me ask a related question about the value of assurance. I mean, I think we have a pretty good sense that if you get assurance, it's just like it's going to reduce the likelihood that there's errors, right? Because like someone's checking, right? So that seems pretty clear. But when I think of like some of the real concerns that are out there around sustainability disclosure, a big thing that comes up is kind of like the greenwashing, the cherry picking, and that's a little more subtle. And so if either of you have thoughts on this, but maybe we'll start off with Jim. Do you have any comments on like what can like who's going to help? So I mean, I have some opinions about this, but who do you think can kind of like help with greenwashing?
Well, you've got clarity, you've got transparency, and then you've got greenwashing, and greenwashing is a term that I think a lot of people put in different have different perceptions of what it means, right? One element of greenwashing could be painting the rosy picture, right? Maybe telling the incomplete story that just talks about the good things. The other side of greenwashing could be fraud, right? Where we are actually hiding or misreporting information. And I think the controls and the participants that are going to affect each of those is a little bit different. We have definitely seen changes in the way things are described and disclosed in voluntary sustainability reports when the CFO, controller, financial reporting function has gotten involved. Historically, a lot of that information had come from marketing or operations or the non-financial, the non-controller group. And when people have started to bring the controller group in, they've gotten and put a little bit more structure around the process, asked questions about what's the source of that information, really treated it like regulatory or external reporting, and applied some of that in. And so there has been a natural progression a little bit away from that because of the sunshine that's been given to the subject and companies trying to pay attention to that. When you think about what the assurance provider can do in that, it's an interesting dilemma. Because Brandon pointed out, and their research has pointed out, not only do you have different types of assurers, but you've got very limited things being assured within you could have 100-page sustainability report that has 40 pages of tables of numbers and information and 5 lines that have a little check mark on it that said, this is what we had assured. And, there could be an over-reliance on that little bit of assurance that it bleeds over that, well, then if this was assured, everything else is probably valid. Could have the opposite effect. Why didn't they get this assured? It might be wrong, so they didn't want to get it assured. And I'm not so sure either one of those extremes is the reality, right? It's that there's not quite a motivation. Maybe that system's not ready for assurance, but all the parties are going to participate in greenwashing. And personally, I believe, unfortunately, it's going to take some, litigation, some enforcement actions, and some other elements that really show people that there's a penalty associated with this. Because I know there's a number of investor groups that are, you can read about it constantly. Right? Companies are setting targets. Companies are talking about what their goals are, and they're not giving me any information on how they're going to get there. I have no idea what's going to create how they're going to get there, or what portion of it's doable or undoable. Can I do it with reasonable cost or unreasonable cost? And some of the more vocal investors, really believe that's beyond greenwashing. It's you're committing securities fraud because you're not telling me that how you're going to get there, and I'm supposed to believe you. And so I do think that we are going to continue to see an evolution of a lot of the qualitative disclosures get reduced and move towards more factual reporting.
Yeah, I appreciate that, and a couple of things that you said there. On the one, about maybe the companies are committing securities fraud here. I've heard people say this before, like my students often say it, but I think I've actually heard like, academics say it, and even some practitioners, like, this is voluntary. So, I can kind of do anything that I want, but actually, you can't lie. And actually, when you say something, anything, whether you have to or you choose to, you also can't mislead by omission. And the SEC has taken a closer look at that recently. And so I think it's important to remember that in some sense.
If a tweet can get you in trouble, something that you say in your sustainability report or don't say in your sustainability report absolutely can. And that's, one of the differences between those assurance providers, right? I'm biased because I am a CPA and I work for a very large accounting firm. So I'm biased. I do believe that the assurance that CPAs provide, all CPAs provide, comes from a different perspective than a lot of other providers. And that is, when we think about our roots being financial statement auditors, we think about completeness and we think about omissions that are changing the story of the disclosure. And I think that we have an opportunity in the sustainability and ESG disclosure space to apply that same type of logic, because we know so much about the business. And it gives us an opportunity to understand, well, wait a second, that disclosure is not really consistent here. And with the vast majority of assurance right now being limited assurance and being over limited numbers of metrics or very specific disclosures, we've not seen the uptick or this issue being really worked through yet. As a profession or as a set of reporters.
So, great points here about completeness. Maybe I'll turn to Brandon and ask then a related question, which is, from an empirical perspective, when we try to think about what is high quality reporting, I think first we should probably just acknowledge that that's not an easy thing to answer. Generally speaking, I mean, we have a bucket full of some tools that we use to assess financial reporting quality. Can you talk a little bit about how we think about that, and also what would it look like in this space?
Yeah, that's a really good question, and that's a very good preface that, as the researchers on this call know, it's very hard to do with financial reporting, and we have many, many years of attempts at that. I think what people have done in the ESG reporting quality space is somewhere in one of like 3 different buckets. It's, are companies using a reporting framework? So just kind of an indicator variable of, are you following GRI? Are you following SASB standards? Even if it's not clear how well you're doing in following those measures, but at least going after one of those frameworks is one of the things that people have used to try and measure this. Another one, I think that's a little bit more emergent, is trying to do like text readability or topic inside of ESG reports, like better understand, is it being communicated or attempting to be communicated like with easier access to the readers of the ESG report. And so I think that there's some newer papers that are trying to do that. And then finally, one that's been around for a few years anyway is Bloomberg actually has a measure of like the quality of reporting in ESG. So they have ESG ratings, and then also kind of ESG performance, and then ESG disclosure performance. And so a number of papers have used that measure, but I think that there's probably still a lot of space for trying to better understand what does quality mean. I think that we've used quality from for financial reporting measures, primarily relying on returns, like returns relations to accruals or something like this. And I think for ESG, at least at the beginning, that'll be harder to do because it's not clear that the information gets into price as quickly or as clearly away as earnings gets into price. And so we'll probably need to think about like more creatively, instead of setting, set the capital markets aside, can we just use the reports themselves or reports plus other non-financial measures to try and better understand what does quality look like here? Oh, Jeff, you might be muted. Hey, Jeff, I think you're muted. Sorry.
Every once in a while, I like to pretend like I'm a mime. And so like, it's just easier if you mute yourself. Otherwise, bad mime. So What I was saying is, I think there are some nice analogies here with some of what we're used to in financial disclosure. So, there is some research that's looked at like number of missing line items from like data aggregators, and so you could also think about, like, as long as there are standards that have specified something, and this is where it gets difficult. But like, if there are standards that have a clear set of disclosures they're looking for, then you can start to do things like counts, and that there would be an analog there. But other times there's not going to be sort of as clear of an analog as well. I see some questions coming in, and Steph Mason was the first one. I'm gonna encourage everyone to hold question or put questions in there. I want to kind of get through some more things, but also Steph's got like special grace, so I'm gonna like she's gonna remain first. I'll come back to her in a bit. What I'd like to do is, if I can, maybe turn to the SEC proposal, because this is a big issue. It has potential implications for a lot of assurance requirements. So I want to make sure we give some time to talk about this, so we can also get questions about it as well. Let's maybe just start with Jim. Can you talk a little bit about like where are we at with the SEC's proposal? It was put out in March, and there's nothing final yet. So like what can you help us understand about the proposed climate rule and assurance as part of that?
Well, I can understand that. I wish I knew the answer to where it stood, because I'm asked that question 15 times a week by audit partners and clients. I think this group is probably aware that not only was it originally put out for comment back in March, they then extended the comment period by 30 days, and then they reopened the comment period in October because there was some technological glitch. I actually don't think anybody actually replied in the 2 weeks that they reopened the comment period, but they reopened it. There were 14,000 comment letters, 4,000 unique comment letters compared to 198 when Sarbanes-Oxley came out. So the attention on this is massive. I think there's a few things that we can agree, and this is what we're advising our clients. One is something is going to come out. For you to think that it's not is unfounded hope. They are definitely going to disclose something, because it has been demonstrated over and over and over again that investors are looking for something. And many of the corporate entities that replied agreed that a commonality would be appropriate. So something is going to come out. If you break it up into qualitative information about your approach to climate and considerations, that's probably going to stick. You should describe what you think about climate and what you're doing about it. And that doesn't require you to set goals. It doesn't require you to do anything about it, but it just requires you to tell people what you think. And I often use this example. You could put in your 10K that we don't believe in climate change. We believe it's fake. We're not going to manage it. We don't care about it. That's it. You'd comply, right? Might not be well received, but you could comply that way. And so the legal challenges that will likely come from it, when you're just asking for information about the company, that it can be proven that has effects on the outcomes and the strategies and the investment decisions, that part's going to stick. Then you've got the quantitative disclosures of the greenhouse gas emissions, right? Scope 1, Scope 2, Scope 3, the intensity metrics and components there. We really think that there's not a whole lot of challenge or concern about Scope 1 and 2. Sure, maybe a little bit about organizational and operational boundaries and some little nuances, but there isn't a lot of challenge or concern over those on a global basis with respect to Scope 1 and 2. We believe that those will come out pretty much as is, right? Maybe a little definition and more closely aligning with the greenhouse gas protocol rather than only a financial control model. But Scope 1 and Scope 2 should be there. Scope 3 is interesting, right? And we won't go into a Scope 3 lesson here. I think the biggest, most interesting element of Scope 3 is the rumor on the street is that they're going to drop Scope 3, right? We've heard that a couple of times. I don't know where the source is, but that's what we've heard coming out of the legal community. And even if that's true, the ISSB has just committed to making Scope 3 part of their disclosure requirements. So now you've got a global lack of convergence, and that's a problem, because you can't have it that way for the long term, where on a global basis you're having entities report Scope 3, and in the US you're not requiring it. You're going to end up with a bunch of stuff in other places because the market is requesting, the stakeholders are requiring it, but to have it not be in the SEC filing is going to become a challenge. The issue is going to be around that safe harbor and how you compute them and how people perceive them. Scope 3 is a great measure to help you understand your business decisions and make different business decisions. But it was never created to compare company A to company B and just looking at a number and concluding that one is better than the other based on a number. And so the market's going to have to learn what those mean, supplemented with lots of additional qualitative information on that scope 3 information before it can really understand what it means. Whether we can go through that learning curve before class action lawsuits and stock price tumbles and different effects on the market is going to be interesting, because I think that's one of the biggest fears that most CFOs have is, I'm going to put this information out, people are going to act upon it, and they don't even know what they're acting upon. And, how am I supposed to deal with that? So that's what some of the concern is. And then the last piece is, the quantitative disclosures in the financial statements. And for the most part, that was universally disliked across most of the comment letters. Too hard. Way too much detail, too small of a threshold. No company has a system today that can identify climate-related elements or the components of affected elements that are done by climate. There's a huge amount of work and effort that needs to go into that. I think what we're advising clients on that one is that one you're going to have to wait and see what they do, because if whether you wait 3 months or start now, you don't know what you're actually trying to get to. So you just need to see it. So anybody who is sitting back and any company that is not taking action on this is really just deferring the inevitable. And so, we are trying to advise clients who are already reporting, how are you validating that? So have you run it through an assurance dry run? Is your internal audit group looking at this? How comfortable are you at those numbers? Because operational numbers are not as precise as investor grade numbers. And now this is becoming investor grade, and you really need to pay attention to that. And the fact that reasonable assurance doesn't come for 3 years in this proposal doesn't give you 3 years to get the number right. You need to be right on day one. You can't come out 3 years from now and go, oh, well, we finally got reasonable assurance and we figured out that the number was wrong. That's not appropriate. So companies really need to pay attention to where the data is coming from, what they're doing to validate it, and how they report it. So we are advising our clients that the SEC proposal is that they're late to the game and it's inevitable. Maybe you might feel good about denying it, but a lot of you are already reporting it already, and so is your supply chain. You're going to need to do that.
Yeah, thanks. That's really good points. And I'll just say that having spoken to, again, like a number of companies recently, many of them, like if they're global companies, they're saying like, yeah, they're thinking about what the SEC's gonna do, but they actually pretty much know what the EU is going to do, or like that the EU is going to do something, and that something is definitely going to involve assurance. And so they're thinking about that. And I can I can maybe give a little perspective on the ISSB as well, which is that on the one hand, the ISSB did confirm that we wouldn't by definition exclude scope 1, 2, or 3. I think it's kind of interesting that the SEC said scope 1 and 2 is material for all companies. They sort of like asserted that, which is a pretty strong stance for a regulator to say, like, we know what material is for all companies, when they generally haven't taken that stance. They could certainly say this is a disclosure requirement, right? Like there can be a specific duty to disclose something that's not necessarily linked to materiality thresholds. Like item 4, if you're a mining company and you own or operate a mine, you have to fill out that table. That's a duty to disclose. And I don't think that they, in Dodd-Frank said like, because it's material. I think they just said like, you have to do this. So to me, it was interesting that the SEC said scope 1 and 2, we assume are material for investors, and scope 3 is subject to a materiality assessment by the company. The ISSB said, we think, companies need to think about 1, 2, and 3, but they're all subject to a materiality threshold. So there would be companies, because of their operations, the type of operations that they have, or because of where they operate, that could quite reasonably conclude that scope 1, 2, or 3, or all three are not actually material to their business. I think where some of the biggest potential challenges would be is where, if the SEC required a particular version of scope 3, ISSB had companies doing a different version of scope 3, and the EU is going to have a version of scope 3. And then what gets into these databases, you see a scope 3 number, and it might be pretty hard to unpack what's in that. And so I have definitely like real concerns about what that could potentially look like. But to the extent that one jurisdiction says you don't have to report on scope 3 and someone else says like, well, if you want to use our standards, you should. I don't see that as too big of a problem. The thing that I see is most confusing is if there's one label for lots of different numbers. That's probably the biggest challenge there. So we still have a lot of things we could cover. I want to make sure we have time for Q&A. Can we kind of just turn a little bit to maybe what the future might look like? So if you could bring out your crystal balls for a second and say something about some of this. So let's think about like, what does this actually look like for the profession? And what do you see? There have been, PwC said that they see this as $1 billion business inside 3 years. It's going to require them to increase their hiring by like 50% or something like that. So realistic, crazy. What do you think? Jim, do you want to give us your, the Grant Thornton view or your own personal view? Probably this is your own personal.
Yeah, I don't give the disclaimer that the PCAOB and the SEC do up front because I am a partner and I am leading the practice. So it should pretty much follow what we're going to do. ESG is intertwined. Like we said at the beginning, these are common business problems that entities have to deal with, and therefore, to say that ESG, that our business is going to grow, by X amount specifically because of ESG, might be a little misleading. In the fact that as our business grows, the ESG topic grows because it's relevant to every entity in every industry. And the question is which components of it, in some, E is a little bit more important. S is a little bit more important, right? And you have different elements of that. So it's hard to say that our business is going to grow X amount because of ESG. But what we are certain is that all of our people are going to need to understand how these topics affect the entity that they're doing services for. And when we think about it from a reporting and an assurance perspective, our firm is taking the approach that our financial statement auditors and our ESG auditors are one and the same. We want to train all of our people to understand how to audit the basic data, metrics, and information that companies are reporting under GRI or SASB or CDP or whatever they happen to be reporting under, because the foundation that we have of auditing the company's financial statements is an enormous help to auditing the ESG information. Take a very commonly reported metric, and I think it was covered in Brandon's element on safety, TRIR, right? The total reported incident rate. That is something that we assure on a relatively regular basis for people who are getting those things assured. And our financial statement auditors are like, well, how do I audit that? I said, well, how did you audit the workers' compensation accrual? And all of a sudden they realize that they know exactly what it is that they were doing. They were just looking at the numeric component of it as opposed to the volume or the activity component of it. So when we think about, where does this go from the firm's perspective, the amount of additional auditing effort that is going to be required is significant, because there's just more work, more things that need to gather evidence around and evaluate and issue reports over, which, being somebody who's kind of close to the profession and everything else, the fact that accounting enrollment and CPA things are declining is a little bit challenging, right? And a little bit scary because the skill sets that we have as auditors are so transferable to this. Our ability to coordinate the use of a specialist, because some industries, greenhouse gases are really complicated, right? Energy and mining and utilities. I mean, there's some stuff that can be pretty challenging. And you need experts in that to help. But the large proportion of it is actually things that people can understand and handle today. And I will tell you that those people that we've rotated through from the mainline audit practice who'd never done anything from an ESG perspective, after they got over their initial fear of what am I doing, realized that they were like, wow, I can really do this. And I don't have any direct data on this, but anecdotally so far, I believe that it's increasing the retention and the enjoyment of the work, because they're doing something more than auditing a debit and credit. And then we've always said that accounting in the profession is wonderful because you see so many parts of the business, which is true. But this is actually looking at the reporting and the elements of it that are even more different. And so the more that the universities and the more that the profession can incorporate this and show that these skill sets go far beyond, it's accounting for greenhouse gases and all of these metrics, that I think that we will appeal to the excitement and the things that bring, I'll go as far as saying, joy to our employees in certain areas. Look, everybody is concerned with some element of a topic that's in ESG. And I'm not a climate scientist, but when I help a company report their greenhouse gas emissions and they start thinking about how they're going to manage it, that's great, because I've done my piece with my set of skills that works there. So there's a lot of work here. There's a lot of opportunity in the profession. And I really do think that the growth, if we can focus on it as more than just a compliance exercise, can help the profession overall.
I agree 100% on that. I think what you're sort of saying about what happens with professionals is something that we should all anticipate, I think, happening for our students. We've told them, for decades, we've said, learn accounting, study accounting. It's the language of business. And then they learn debits and credits and revenues and expenses, which is super, super important. But they can't show up in a business and suddenly start talking just like revenue, expense, debit, credit, and like actually fit inside of the organization in a lot of ways. That's not how most of the organization actually speaks. It's a big part of what matters. But if they're also learning about what are the drivers of those revenues and expenses, that they're actually just going a little bit deeper into like, what is it the company does to actually create these revenues and expenses, and what are some of the risks and opportunities related to that, I think they love it, actually, and they learn more about what businesses actually do. And you're exactly right, Jim. This is completely in our wheelhouse as a profession, and it isn't just for reporting, and it's not just for assurance. There's also tax implications, and there are big, thorny managerial questions as well. How do you actually run a business well with this information? And I'm also sympathetic to the idea that it's big and scary to professionals when they first hear that they may have responsibility for something like this. When, over the last 10 years, as we've been engaging with companies, you walk into, a CFO or a chief accounting officer and say, like, have you thought about disclosing more on sustainability? And they're like, what are you talking about? And if you actually can kind of like help them see that, well, this is accounting for business activities. So to begin with, we're talking about things your company actually does. All of a sudden, when you start to get specific, a lot of that fear is immediately dispelled. They're like, oh, well, yeah, I mean, I know how to think about the energy efficiency of the electronics products that we sell as part of what we think about, from a marketing perspective and from a design perspective. Now, where does have they gathered data on that? Have they set targets related to certain things? Maybe, maybe not. But they've certainly thought about things. When you talk about social issues and human capital, they absolutely have thought about ways to manage and retain key employees. That doesn't mean that when they first think about social reporting, like they could have a complete panic attack. So I think some more information often helps a lot on this. I want to maybe think a little bit about what does this sort of look like? We've thought for years, and maybe I'll turn to Brandon on this. We've thought a lot about, where's the competition in the big four? What are implications around some of that? Adding ESG into the mix here definitely, in a sense, it changes where there might be expertise, where there might be opportunities. Any insights on this, Brandon? What we might see kind of going forward on there?
I would agree with the earlier points that were discussed with respect to there being two sides to the competitive effects of this. And a side that's interesting to me is the competitive effects on the staffing or the labor market in assurance. So essentially, if you are bringing a more interesting mix of work to your potential staff, then you might be able to grow and retain your staff more easily. Meaning that more people might come into accounting because they're not just doing financial output. They're not looking at just financial outputs of firms. They're also looking at other non-financial outputs of firms. And if that's relevant for how they think about the world, then maybe they'll be more interested to actually pursue that career path. I think one of the other interesting things that we think about with competition on the product side, so this is like the ESG assurance, is that in auditing, generally, it's never fully been resolved. Like, is auditing made better or worse by competition? So the idea that it's made better is because, of course, we want, to provide high quality products. And so if you have competition, then maybe you provide higher quality products. But the thing with auditing is that it's hard to actually observe quality. We've struggled with this quite some time. And so it's unclear whether high audit quality is delivered until like very much after the fact, when maybe things are misstated or fraud is unearthed or something like that. And then we know, it was actually low quality. And so competition may lower quality because now there's, with this opacity in quality, there's kind of a race to the bottom. And so I think it's unclear what the competitive effects would be on ESG reporting quality in the same way, because there's maybe just too much opacity in what it means for there to be high or low ESG reporting quality. And so something we can think about, and academics think about this all the time, is better ways to measure it, or better things to do to disclose how things are high quality versus low quality. And so the ESG reporters should be thinking about that, because in order to decide to do assurance, you want to know that it's actually enhancing the credibility of the reporting. And so more information around what's actually being done for assurance, I think, would be an interesting way to go if there was kind of concerns about competition in ESG assurance.
Thanks, Brandon. And whenever I hear the language of "it's not clear whether," I think, oh, that's code for somebody needs to write a dissertation. So hopefully people are listening here. So, but that actually leads into, I think, in some ways, thinking about aspects of competition and what this kind of means. It goes back to I think a question that Steph actually had raised in the chat. And so since we want to give time for Q&A, I'd encourage everyone to raise their virtual hands, and we'll try to just take you person by person. But I want to give Steph an opportunity to ask her follow-up question to Jim. So please.
Why don't I just jump in it? Since you typed it into the chat, I can
But
see
I wanted
it.
to give Steph a chance to be like,
Okay.
I'm Steph. She's so great.
I have construction noise, Jeff, so I'll let him just go ahead.
Perfect.
Well, Steph, thanks for the question. I think first off, to determine or understand whether or not people providing assurance over ESG information in a public document should register with the PCAOB is, what are they actually trying to get at there? And the SEC pronouncement did not dictate that a PCAOB registered firm has to provide the assurance, but it did outline the quality controls and the approach that they take to the quality they would have to have in place in order to qualify provide that. And for all intents and purposes, it's the quality controls you would need to have to be a PCAOB registered firm. And the practicality of what's going to happen here is, and we are already seeing it, is, there's a lot of different firms that can provide assurance now and do provide assurance, as Brandon's study shows. Some of those firms have started to drop out because of this expectation of, I don't want to have those quality controls, or the market is, looking for more information. I think as soon as somebody gets sued over it, they're going to drop out as well. Accounting firms don't like to be sued, but it's part of what we deal with, so we understand it. And eventually, my guess is that all these providers will register with the PCAOB, because somebody's going to misreport something, and they're going to say, oh, there was no quality around that assurance process. So it's probably more inevitable than it is should it occur right up front, because it probably will occur. But when you think about the different firms that are providing it, there's got to be some level of consistency around those reports, because right now, as Brandon pointed out, sometimes they're not even present for the people to read, right? It just says we got it assured. Some of the reports that you read, and this is almost verbatim. I had read a report from a non-CPA firm that said, we performed a light touch desktop review of the information that contributed to the reporting. I have no idea what that means. And light touch was in quotation marks, and that was in the actual report that had been published. So all that does is, I think it provides a massive opportunity for the assurance providers to help readers and users understand what they did and how they did it and what the outcome was. And if you think about what CPAs do, I mean, we're pretty good at creating structured reports that provide that. So, I don't believe that all the non-audit firms will disappear. I mean, there's 2 or 3 of them that got pretty good market share right now. They'll probably invest in that. But as the metrics grow beyond maybe just the environmental component, and I think Brandon's research showed this, the environmental research or the environmental metrics being reported on by non-CPA audit firms follows where that came from in the first place. How did they develop the metric? How did they develop the reporting? Hey, can you tell the market that it wasn't just us, that somebody looked at it? When an entire sustainability report and all of its metrics are ultimately assured, which is where this will go in a decade or so, the financial statement auditors are so well positioned to do that I think that the market will ultimately shift in that direction.
Brandon, since you were specifically named twice in that response, I just want to give you a chance to add your 2 cents, if anything, on that.
No, I thought that was pretty complete. It was basically kind of touching on the space of how do audit firms or these non-financial assurers actually differentiate their service. One of the other things that we are looking at is this kind of limited versus reasonable, and reasonable is like 10% or less across metrics. And so it seems like there is a lot of limited, so what we can think of as like quarterly reviews of financial statements, that sort of evidence gathering rather than kind of testing of the numbers. And so I think there's also a lot of scope for increasing kind of the confidence around more reasonable assurance in different metrics. And so I think that trajectory also could take off in the next decade or however long, and that'd be very interesting to watch.
Great, thanks. Okay, I think our first virtual hand is for Ryan Guggenmuss.
Hey, thanks, Jeff. So I apologize for my kind of lack of boots on the ground knowledge of this stuff. But my question was, so in a financial statement audit, some items are just clearly more difficult to audit than others, right? I think about you could hand cash to a first year versus, auditing a complex estimates very different, right? And as researchers, how should we think about this kind of distribution of auditability of these items in the ESG space, right? E versus S versus G, or across companies or across industries? I'm just having a hard time wrapping my head around even where, for the people actually doing the audits, the kind of difference in the way we should be thinking about how they do their work.
Brandon, you want to go first, or?
Sure, I could say a few things. So when we picked measures to try and collect, we were basically saying, do these measures kind of meet what we think are 3 good criteria for their scope for assurance? One is that they're probably useful to some stakeholder. The second one is they can be numeric. And so you have to have some controls or processes around deciding, here's the numeric thing that I want to disclose to those stakeholders. And then 3, that there is some agency issue or potentially an agency issue in reporting that number. And it seems like if those 3 criteria are met, then assurance might be valuable. And so I think your question is very specifically to the second one, which is when there are differences across metrics in kind of measurement, how do we think about that in comparison to audits? And coming back to something that Jim said earlier with greenhouse gas emissions, I think where's the boundary of the firm? And when do we include an asset and its emissions inside of our scope 1 or measure or not, is kind of a very similar thing to thinking about when we're looking at the consolidated financial statements, did we get all of the necessary VIEs into our consolidated financial statement? And so I think for each metric, and then again, across different companies, we're going to have those same sort of difficult kind of things to think about. Like in a construction firm that has a lot of joint ventures, it's very hard to figure out, is this joint venture part of the consolidated construction firm or not? Very similar with greenhouse gas. It's okay, we have VIEs that are also doing emissions, and we have to figure out, is it going to be included as our combined scope 1 emissions number or not? And I think that's true across metrics, and I completely agree with you that it's complex because there are different challenges for different industries, like maybe social measures and, are we treating our employees well? Somehow, like not subjecting them to a lot of safety risks is going to be more important for certain industries and not so important for others.
So yeah, I actually wasn't even thinking about it with scope, so that's even more complicated. I was just thinking about like if you have like a goodwill, like your subjectivity and a goodwill estimate could result in things that are many times materiality, right? But we're still going to audit it because it's part of the financial statement audits, where it seems like here it might be a little bit different.
Yeah.
Yeah. Thanks, Brian.
Jim, did you want to add anything on that particular?
I would say that, there is an element of is the measure of the information objective or subjective, influences things, and in a lot of the metrics and measurements, even in some of the emissions, it's relatively objective, right? I mean, the data can be gathered and it can be accumulated, and yes, you've got a boundary or what are you including and what are you excluding component. But in other things where you get into things like employee engagement or training effectiveness or scope 3, you've got a lot of estimates and assumptions that go into that become very difficult to compare across, because you're not applying them against that same type of a standard like goodwill impairment, where you're comparing it to a valuation exercise, right? So there's a lot of assurance that's occurring right now on scope 3, but I can kind of summarize that assurance is it basically says we calculated it the way we say we calculated it, and that's not necessarily the same way that the next company calculated it. So comparability becomes really challenging.
Excellent. Thank you both.
I just want to emphasize that is something that we should all be very, very familiar with from decades of financial accounting, right? Like we know that there's direct verifiability and indirect verifiability. And, what do we assure about depreciation? How the company calculated it, right? And is that like a big component of earnings for some companies? For sure, right? So we do accept this, and I think this has then less to do with how auditable is that? Like you can definitely audit depreciation. I think it speaks to under what circumstances is this is a measure going to be useful? And that's a really big important question. And the more estimation there is, especially the more there's kind of industry-wide or even economy-wide factors that have a big part of that, then you're kind of left to ask, what's this really telling us about an individual company? Big important questions there. I would just encourage everybody to not over extrapolate on what sustainability is, and I wouldn't even over extrapolate on E versus S versus G. I often hear people say, oh, E we can assure, but S, that's so fuzzy. Employee deaths is a fairly hard number, but employee engagement might be fuzzier, but there are definitely ways companies can say that they're going to address it. And there are some really complex things around, energy usage or impacts on biodiversity. So it's really going to be kind of item specific. And I appreciate Jim and Brandon's comments on that. Let's go to Marcus.
Thanks, Jeff. Jim, my question is around materiality in practice as it relates to assurance. So it seems to me that a lot of the discussion around materiality on ESG and expanded reporting has been topical. So if you look at the, former SASB, now maybe ISSB materiality matrix, it's topics by industry. And it seems to me that if we're going to provide reasonable assurance on disclosures, that materiality has to also include precision and accuracy of that information. So my question is, essentially, are your teams identifying material misstatements? What do those look like? How do you set planning materiality? What are the principles that goes into determining whether something is a material misstatement in this space? And then just an anecdote, the one place I've been able to find actual numbers for precision was in an Apex, I think, report that said we set materiality at 5% of the metric, which seems to me to be incredibly unhelpful, because 5% of greenhouse gas emissions might be sufficient, but when it comes to something like a gender pay equity ratio, 5% is huge. So I would love to get your thoughts on how this is actually looking in practice, and maybe some examples of misstatements you guys have actually found and called material misstatements.
All right, well, that's a semester-long course in that whole question. So let me see if I can pick up just a couple of tiny pieces of it. I think the happiest thing I've got as a practitioner dealing with materiality in this space is that it doesn't use the word benchmark anywhere, because there isn't a benchmark. So you really get this concept of relative materiality. And when SASB talks about the materiality matrix, those are topics or areas that are material to decision useful information for that entity, right? So it's not trying to say what would be material within each metric. So it's a different materiality concept. When we think about materiality for planning and engagement or evaluating the findings of that engagement, we look at a couple of things. First, the greenhouse gas protocol does have a statement in there that talks about 5% is likely a relevant number. So we always think about that, not necessarily as a ceiling or a floor, but just as a reference point. Depending on the industry, scope 1 and scope 2 can be 5% of the total emissions when including 1, 2, and 3. So if you were to apply 5% over all the emissions, it would be 50 times at the scope 1 before you got to 5% of the total. And that trend might be okay, right? It might very well be, I don't care if the scope 1 number is misstated by 100%, because trending wise, and what it's saying is that scope 1 is just not material there. Any services business probably doesn't have very much scope 1 emissions, right? But they have scope 2 through their real estate footprint, and they clearly have scope 3 through employee commuting and business travel, and maybe a little bit of purchase goods and services as to how that works. So we look at materiality as, what is it doing from a trend perspective? What is it doing to the overall reported perspective? But most importantly, how is it relating to what the company is saying that its goals, targets, or approach is? And if they're saying that they are going to be reducing, their emissions over a certain period of time, or they're trying to accomplish a certain pay ratio or demographic balance, that they're defining their own level of materiality based on what they're saying they're trying to accomplish. So we use a dynamic materiality concept, which is a pain for a traditionally trained auditor. They're like, give me a number, just tell me what the number is. But you can't do that. You've got to look at it in context. Most of our misstatements that we are identifying have to do with the availability of data. And therefore, they made estimates or excluded elements when they really shouldn't have excluded components. They might be using an inaccurate or an inappropriate emission factor. And what we see quite frequently is companies who are trying to take an offset and apply that against say a scope 2 information. It really wouldn't qualify from that perspective. They didn't buy it off the same, it's not applicable to the same time period or the same grid. So they could report the amount of offsets they have, but to actually report it as a net number wouldn't meet that criteria. So, and that's because we're focusing on individual metrics right now. We're not focusing on the total picture of everything. And we haven't gotten into a lot of the, looking at the direction of all of these issues or items like we do in a financial statement. Are they trying to paint a picture that's a little bit different here? So hopefully that got into some of it, Marcus.
There's so much here. I feel like, we could just sit and talk. I have like a bazillion questions I'd like to chat with you about on this one, Jim. But we only have 7 minutes left. So I wonder what, I know that Jamie had her hand up and then she put it back down very politely, but I would like to actually, maybe if we could just hear Jamie's question, Jonathan's question, and Colin's questions, and then see if we can hit on those in the minutes remaining. So maybe, because I think, Jamie, you did have your hand up next.
Yeah. So my question was the same as Marcus's. So when I teach financial statement auditing, I love teaching materiality. I love going through the rules. I love talking about qualitative materiality, and I have the students do a case and tell me if there's a material misstatement. And even in a financial statement audit, none of my groups agree on whether there's a material misstatement. And then when we go to ESG assurance, my lesson there, the materiality concept comes up and my students are like, well, how do you identify a material misstatement in ESG assurance? And I'm like, I don't know. And so like, I think that the answers that I heard are really great and help me kind of get some context on how the firms are doing it, because I'll just admit when I teach that, I just kind of like tell them what materiality is and what the definitions are, like dynamic, double materiality, and just say, I don't know how to do that. So I want you to move on just because my question was too similar to what was already asked.
All right, thanks, Jamie. Let's quickly get, I want to make sure we get both questions, Jonathan and Colin. So Jonathan, you want to give your question first, and then we'll hear Colin's. Where did Jonathan go?
Jonathan, you're muted. Just.
All right. Yeah, my question is probably more geared towards Jim here. About a dozen years ago, I did a survey of corporate responsibility officers trying to understand the lack of demand for assurance in the United States. And one thing we found was really interesting was that there's a lot of companies that get assurance and just don't tell anybody about it. Is that something that we're still seeing today, where somebody would get assurance from an external provider and that is not share the results publicly, just to get the internal benefits of improved reporting quality? I just wonder if that was something you're still seeing today.
We do see that today, but I think we're seeing it in a context that's a little different than we might be thinking about it, from the perspective that the engineering or the operations group of a company, and it happens in emissions more than anywhere else. So I don't see it much in the other metrics. Engineering or operations, it was tasked with gathering this information and putting it together. They hired a third party to help them build the systems, or maybe even capture or get the data. And then that entity or another entity says, yeah, we were associated with the gathering and the compilation of that. It wasn't just management. And they're using lowercase a assurance as a word a whole lot more than they are something that was conducted under a set of standards that went through due process that people understand and can be reported. So I think I might use the word there is validation of the information occurring that people aren't talking about, that is not the same as more of the assurance that's occurring.
I'm pretty sure Brandon could also comment on this, but I do want to make sure we get Colin's question, and then maybe there'll be a chance for that. Colin?
Yeah, appreciate it. Just a quick one on maybe Jim's experience working internationally in this space. So financial statement audit for a multinational, a lot of times you're outsourcing some of the work to kind of one of your network firms. I was wondering if you were running into that at all here, and if there's different expertise or, a different outlook in some of your network firms.
Do you want me to shoot at that one, Jeff?
Yeah, Brandon, you want to give like 2 seconds on the previous question?
The only thing that I could say about that is there is definitely differences between what you see in those reports that companies publish on their websites and like the other data source that I look at is like what Refinitiv, which maybe they're surveying companies, or what companies then report to CDP. And so you can see level differences in assurance between those two sources just coming up as a result of, they don't put it with their assurance statement with their ESG report, or in the ESG report, they do indicate assurance, but don't have any like statement attached or any information of who the assurance provider is, et cetera.
I've also seen companies be careful about where they make the assertion that they got assurance, like keep that part out of a regulatory filing, being careful about that. Jim, to Colin's question, could you touch on that?
Yeah, so I think that as people around the financial statement audit world, we'd like to associate that concept with the group audit concept. And, how do I determine where my risks are coming from and what my sources of information are, and how am I going to allocate the work out around a whole bunch of people? And we're actually finding the execution of this as a group audit to not necessarily be the same, because there isn't a country by country reporting requirement that exists with a lot of those financial statements. A lot of times you've got a local statutory audit and you need that set of standalone information that comes out of that general ledger. Most of this is consolidated reporting or business unit reporting, or something that spans across those geographic borders. So it doesn't necessarily need to have the same level of boots on the ground in all these countries in order to execute the engagement. Depending on whether you're trying to look at individual records for certain things like some of the DE&I or the workforce information that might be kept in a country. And so what you see here is you see more like specified audit procedures being asked to be performed in a particular location because that's the source of the data. And so what we are looking at from a Grant Thornton perspective is most of the work gets done at the consolidated level or the group or whatever part of the company is coordinating that information gets aggregated electronically and then looked at by whatever team we want to allocate it to, whether it be the shared services center or the domestic auditor, however we want to do that. But it's not like inventory observations. It's not like having to perform search for unrecorded liabilities or specific procedures at each location to get a coverage percentage, because we can cover that. But there are situations where some of the group audit concepts are relevant, and we've asked the Auditing Standards Board from ASAC perspective they have an attestation task force, and there's like 11 items on the list of things that are important, things like use of specialists, the group audit considerations, all of those that we see frequently in the financial statement audit that are creeping their way into it. But right now, the global need for this is not as challenging as it would be from a financial statement audit perspective.
All right, I think we're at time. I'm going to pass it back over to Jamie, and I'll just say myself, huge thanks to Jim and Brandon for being willing to share this expertise. I found it really engaging and insightful. So thank you. Jamie, back to you.
Yeah. So same here. So thanks everybody. We're running out of time, and I hate keeping people over. I think the one last question that I think Jim and Brandon, if you ever have thoughts on, I would love to know what areas of research could be most beneficial to the firms, or if we need to change our teaching to help our students be prepared. So just think on that. And if you have ideas, I would love to hear them later. But for the rest of you, have a great day. Check your inboxes. I will be sending you something hopefully soon about potentially having an event at the midyear meeting. I'm trying my best in that regard, but have a great day. And Jim and Brandon, if you have a minute to stay on, that would be great. And thanks a bunch, Jeff. Recording.